Joined and welcome back after the summer, Arne Rasmussen, Chief Analyst and Head of Research at Global Risk Management, Paul Hicken, Chief Economist and Editor-in-Chief at Petroleum Economist, and Rachel Ziemba, Adjunct Fellow, Center for New American Security. Rachel, let me start with you and talk about American security, but in the context of the Gulf here, where I sit. Obviously, we've seen the attacks on Qatar a couple of days ago by Israel, and the neighbors reacting, and the regional leaders here very cross. But what is going to think be the consequence of that? And is that was what happened 2 days ago? Final evidence that America is not securing the Gulf, something that has been cast into question anyway, more recently. But what do you think is the picture looking forward on that front? What should Gulf countries be thinking in those terms?
Yeah, I mean, I think Gulf countries have had to sort of think about this differently, even going back to the first Trump administration when we had the attacks on Saudi Arabia that were not fully, definitely not fully met and supported by the United States. I think this is just another sort of nail in this context, and the Qataris and the Gulf more generally have right to be upset about the violation of their airspace in the context where they were playing an important mediator role requested by the U.S., requested by at times even the Israelis. So I think it's unlikely to have major near-term consequences, and even for the energy markets. But I think this is just another break as the Gulf gets used to a more transactional United States that's trying to pivot more internally. For the oil markets, I don't think there's a lot to see here. They're very much in show me the outage mode. And this does seem like a one-off. But I think overall, you're going to see Gulf countries, paradoxically, perhaps buying more military equipment, buying more things from the United States, and looking for what are the types of partnerships in AI and the like going forward, but looking for other security relationships and partners as well. But at the moment, there aren't a lot of others beyond the US that are offering.
Okay, Qatar certainly spent billions of dollars already buying US arms, and of course you have a big base there, and yet that didn't make a difference. So it's certainly a confusing time. Paul, welcome again. Let's talk a bit about oil and oil prices. A lot of, after APEC has just wrapped up in Singapore, a lot of talk there about the coming quarter, whether it's macro policy from the US but oversupply is still kind of hanging over the market, isn't it? But China's been taking a lot of that into storage. What's the sentiment, do you think, going into Q4? Are we going to see prices drop further from where we are now?
That's a great question, and thanks for having me back on. It's great to be back. I think the big question you see yesterday where the IEA and the OPEC had their monthly forecast come out, and what strikes me is that we're in September. We've got 3 months till Christmas, and you've got sort of a 600,000 barrel a day gap in demand growth forecast between the two, and about 700,000 barrel a day gap in supply side forecast between the just for this year. I mean, that's insane. I mean, the gap, and while it suggests partly the uncertainty, it's true. It just shows how kind of this modeling is kind of broken in a way. And you think about most of the consensus, a lot of the consensus sort of seems to lend towards the IEA forecast, which are kind of this sort of glut that's coming. We're coming out the summer demand that's sort of holding things up. But I don't think that's that supply side glut.
I mean, our suppliers react. I mean, OPEC, as you said, one is OPEC forecast, one's IEA, but does it matter what the forecasts say anymore? Because, we've got suppliers adjusting on a monthly basis in a way, if you think of OPEC plus as a group, and there's plenty of flexibility in that system, isn't there? So how does the market care in the sense? Is that why we're seeing prices hold steady?
Exactly. I think you make a great point. I think that's exactly. I think the markets are trading very much on the day to day, and basically where we're at, we're in a happy place. And like you said, OPEC and China can clearly adjust if prices go lower. And what we're seeing is clearly that China's at the moment that's taking over the mantle of sort of helping support prices by keeping buying. And I know there's like a lot of concern that China's going to stop doing that, but actually, if prices keep going lower, China are strategic buyers. They're more likely to keep buying. So they actually, it's kind of almost we're in a kind of loop that may well keep prices above the $60 price, even with the sort of more gentle approach of OPEC, which is to really continue this new strategy to keep bringing barrels back into the market.
Actual barrels, though, are what count, right? And that's in question in the sense that, even the ones that have been pledged so far, perhaps they haven't hit the market yet, and who knows what's going to happen from October. Arno, good morning again.
Good
I mean,
morning.
let's talk a bit about the economic mood, if you like, and what that means for demand. I mean, we're talking about supply adjustments, but what about demand, China demand for the next quarter, if you're looking at a global picture, US economy and how that might be pulling on supporting oil? What do you see? Would you see us weakening as we head towards the end of the year?
I think it's pretty obviously that the U.S. economy is slowing down at the moment. We see it in the labor market numbers. There's basically no new jobs being created.
Yeah.
But we tend to overlook it a bit because the financial markets are getting a boost from rate cuts from the Fed and fiscal spending. So we tend to overlook that. If we look at the PMIs, the ISM across the globe, yes, they are moving higher in Europe, but they're still around 50 or below 50. Same picture for China. It's not impressive. We are a bit blindfolded by the hopes that we will now get a push from central banks, and we are getting that. And the pivots that we are seeing at the moment is always the time where markets rally. So I think without the weaker dollar, I'm pretty sure that Brent would have the oil price would have been lower today. It's getting a bit of artificial support. It's a bit like we're saying in financial markets that the market's picking up pennies ahead of the steamroller, and the steamroller is this glut of oil coming to the market here in Q4. And I think we see it also in the market, the way the market is trading. If we don't get these geopolitical news, we edge lower. And we get them, and we get them more or less every day, of course now. But it seems like we need the push from the geopolitical news to keep markets up. So I think we are in a bearish market. We are edging lower. But of course, if we let's say we go to 60, then there will be a reaction, probably also from OPEC, I guess.
Yeah, you think that would be the price at which it might trigger a reaction from them in policy?
It's hard to say where it is, but actually, when I wrote my morning comment this morning, I said to myself, why do we have this difference between the OPEC and the IEA forecast? They're huge. One is very bullish, the one is very bearish. Of course, they can be manipulated and all that, but basically, the OPEC report is a perfect setting for OPEC to reverse, because they can say, we didn't get these optimistic demand. We were surprised by the inventory build, and now we have to stop adding more oil to the market, and they can make a revision to their forecast. So I don't think it's a given thing that these 1.65 million barrels per day. Note the very specific numbers here: 137,000 barrels a month.
That's very specific.
Very specific. They are adding some oil, but it's no guarantee that will continue in 2-3 months' time.
Yeah, absolutely. I mean, it's been declared for October onwards, but many are doubting that it will continue, and who's going to fill that gap as well? Who's able to actually with the capacity?
Exactly.
Rachel, just back to the US. I mean, I want to just delve a bit more into your opinion on, future of US Gulf relations. I mean, putting the security aside and buying arms and AI investment and all that probably isn't going to change, but. We've seen obviously the Abraham Accords being, perhaps start to be put to the test. I mean, I'm not sure what the UAE's position will be, but the whole, Saudi now and UAE rallying around Qatar, obviously for obvious reasons. Do you see a change in US Gulf relations as we go forward? Do you see the Gulf turning eastwards to sort of fortify its other relationships that it already has, or do you think this will be a temporary blip?
So I think this is the Gulf has already been turning eastwards on an economic side. In that context, some of that's as the U.S. produced more oil domestically going back over the last decade, and maybe some of the balancing that Arna is sort of pointing to. Maybe some of that as we head into next year will be lower production out of the United States. Right, we're seeing definitely stalled drilling. Job growth isn't the only thing that is stalled. It's not been enough to sort of offset the OPEC plus capacity additions, but that would be something I'm watching. China's already the largest trading partner. Trade with India is increasing, not exports of oil per se, as India's really turned to Russia. I mean, something we can get into. But China is not the kind of security partner. None of these countries are. So I think there's still a balancing act, and as the U.S. is trying to both turn inward, as we see out of the defense policy bill, as we see out of the Trump administration, there's a different kind of maybe pivot to Asia threats that is still sort of going on, and I think that puts folks in the region in a difficult position. I've been watching also rhetorically these closer ties between the Gulf and Turkey, right? Not always an easy relationship, but sort of as Turkey is playing a larger role in the region, and both the Gulf and Turkey see interests in balancing against Israel and to extent the United States. And then, of course, the Gulf is still dealing with both this desire to keep Russia as in OPEC plus, but at the same time, the fact that they have lost some market share in countries like India, as Russia has been in that market. Russia, in a way, Ukrainian drone attacks on Russian refined products maybe will start to balance out that market share a little bit more. But I think there's a lot of balancing ahead, and some of these moves are really longer term in nature, I think, and some of it's the same kind of balancing considerations that the Europeans are having to think through, as you have the US thinking about the security umbrella in a different way, willing to be a market, willing to be a seller of military equipment, but really a competitor on the energy provision side.
Yeah, and then of course you have the whole tariff threat sort of as a layer through winding through all of that as well. I mean, Paul.
Oh, exactly.
Rachel mentions Russian crude going to India. Yes, India's been defying the extra tariff pressure from the US and continuing to take that, at least for the time being. What about Iranian crude? Talk of snapback sanctions maybe kicking back in at some point. Paul, do we see any dynamics changing there? Do you think in the last quarter, over the summer, or even going forward, or if Iranian exports continued more or less on the same level and set to do that, do you think, for the rest of the year?
I think there's the 101 of oil markets, which we've seen over the summer with sanctions, with geopolitics, is that oil tends to find a way. I mean, most of the barrels will continue flowing. I think it's very hard, even with pressure on Russia, with pressure on nobody. The person
There's no
who
real pressure on Russia, though, is there? I mean, Trump has failed at that.
It's
I mean,
true.
that's
Well,
not really-
exactly.
yeah.
No, just on India, right?
Yeah, exactly.
But
Yes.
I think that's the point. I mean, whether you say he's failed or not, it's more the fact that he actually doesn't really he doesn't have the stomach for
Doesn't
it, to be
intend
honest.
to. Yeah.
He doesn't have the stomach to actually see lost Iranian barrels, lost Russian barrels. He may talk a big game on these type of things to exert some pressure, but actually he wants barrels to flow. The last thing he wants is oil back up $80-$90 a barrel. So he's in a happy place as well as the oil market. So I think, and then secondly, it's very hard to stop the barrels, even with secondaries, even with these things. Even if he did have the stomach for it, it's very hard to still stop. You might put grit in the wheels. You may reduce some barrels, which you've seen with Iran, which is like 500,000 barrels a day shy of what they can produce. So there is a material amount that comes off, but it's not material enough given the amount of at this point, OPEC spare capacity around 4 million barrels a day, probably off the market, which, that just the 2 million barrels a day of OPEC plus cuts plus the voluntary 1.6. So it's up towards 4 million that could potentially be brought back fairly. Well, maybe that's not all those barrels will be back quickly, but at least some of that, especially from Saudi and the UAE.
Arna, I mean, yes, barrels can be brought back in their spare capacity, and the forecasts are that, that there's an oversupply, but also there's the argument that this market isn't looking at fundamental supply and demand. It's looking at, technicals and liquidity that we mentioned at the top of the hour, and that, oil must start to follow everything else that's been going up, whether it's equities, whether it's gold, whether it's other commodities, and it'll just, in the wave of everything being inflated, will indeed start to go up. And putting aside any more geopolitical disruption, what do you think? Is that a fair argument?
It's a fair argument that correlation will eventually come back. But I think it was Keynes who said you can stay. I can't even remember now. Maybe you can remember, Rachel. You could stay solvent longer than you can stay. No, never mind.
Yeah.
But yes, correlation would say that oil should be higher. The weaker dollar would indicate that oil should be higher. But do remember, at the end of the day, this is a physical market. Oil does not get the support from rate cuts to the same degree. Yes, it supports the economy, it supports demand in the end of the day, but equities, bonds, they actually get a direct price impact from lower interest rates because it is the price of a bond, the price of a stock is the discounted cash flow of today, this future cash flow that decides the price of an asset today. It doesn't apply to oil. It is a commodity, it's a physical. So these correlation can stay broken for a long time, and maybe the answer to your question is more that oil would actually have been lower if it wasn't for the correlation with risky assets. Then oil would have would have been lower because then it would have only been supply and demand. So yes, liquidity, inflated assets, lower bond prices, higher equity prices, tighter credit spreads, and so on. It supports higher oil prices. But at the end of the day, this is a physical market. If you believe the price is too high, you can actually do physical delivery in this market.
Yeah, and you need, so it needs the support of real sort of PMIs, manufacturing on the ground, an uptake on that, etc. There's our survey question for today. OPEC Plus is likely to continue with supply increases through Q4, as long as Brent remains close to its happy place of $65. So as long as we hold that, they will continue to increase supply. We were talking earlier that, if it hits 60, perhaps they'll change their policy. Let's wait and see. Rachel, let's talk a bit about tariffs. Go back to the tariff picture. I mean, where do you see this sort of ending at the end of this year? It's been a very dynamic, volatile year of statements and action by the US on its tariff front, statements and reversals of statements and intentions. Do you see it settling in any way as time goes on? Or are we going to just continue to see this game being played essentially by Donald Trump?
I think we see
Keep
tariffs
the markets guessing. Keep countries guessing.
Well, there'll be some element of that. I think we see it sort of settling at somewhat higher tariff levels than we have now. We have coming up in November. By November, we'll have the Supreme Court ruling on the legality of these broad tariffs, including some of those we're talking about. Well, not exactly those with India. Market actors who are hoping that means that they'll get all their money back are probably mistaken. I could see the Trump administration using other tools. The government has become addicted to the revenue that comes from the tariffs. It's not enough to come anywhere close to closing the US fiscal gap. If anything, we saw in August that gap is widening, even as tariffs hit the highest levels they have since the 1930s, which is not really on a lot of people's bingo cards. And so that has its own.
And how is it hitting supply chain costs for those American businesses? I mean, is that hitting much more than the revenue?
It is.
I suppose, benefit.
I think it's hitting at the moment. Multinational companies have been able, as usual, if you're a large company, you have more options. You can move things around, you can play around with prices. Some of the multinational companies, they also say, you know what, we're getting a tax cut, right, coming forward. So that helps to offset it. I think where we're seeing the most supply chain disruption is in smaller businesses and even consumers. And the consumers, no wonder businesses are not hiring, right? All of these trends go together. And that goes back to a point that you and Arno were just talking about of, the rate cut dynamic and the reflation story. How much growth you get in the context of rate cuts depends on also how weak growth would have been regardless. And while the US has been resilient, I think we are starting to see that drag. We have other important things coming up, like new shipping fees on ships sort of that will be transporting not necessarily energy, but other products to the United States. Those will hit in October. And that I think only puts more pressure on shipping and shipping prices. On the energy side, the fact that we have all this floating storage and we have these tankers out of commission to some extent from sanctions actually means that there's probably again more costs for some of the oil that's actually trying to get from point A to point B. So I think we have a dynamic where the addiction to revenues, the desire in that way mean tariffs are somewhat higher, and there's a lot of uncertainty. And I think there'll be less of the investment in the United States in the industry than the Trump administration is hoping in that regard. And
Okay.
so that's where I guess I
Yeah.
tied on to the bearish side.
Okay. Paul, let's talk a bit about China and Chinese demand. I mean, we mentioned how it's been obviously stockpiling quite heavily. It's something quite new. I mean, the volumes at least are quite different from the average. We also have a headline on our bulletin today talking about Saudi crude sales to China set for October jump because they've cut their OSPs. Paul, is that a sort of trying to protect its market share in China again? I mean, China was taking a lot of Iranian oil, but has, again, where we're at with that sort of slowed down a bit because of the secondary sanctions. What do you think the intention was there from Saudi?
Yeah, certainly. I mean, Saudi reacts to the physical market, but basically it's seeing that the situation is that I think it's an acceptance that actually to compete in the market, that prices need to be a little bit lower. I think it's a reflection partly that prices are going to be a bit lower in the competition in the competitive market. And I think what it does say is that Saudi Arabia, as a kind of de facto leader of OPEC, is happy to have lower prices and to maintain market share in this way. We are in a market share war by stealth. That actually, I would argue that OPEC Plus and as Saudi as the leader of this will be happy to tolerate prices down to 60 and maybe even lower than 60 to reset these baselines as a broader strategy for OPEC Plus to reset baselines. I mean, you see this move away from in the summer. I think it's a fundamental break for what they're doing in OPEC Plus over the summer to get rid of that de facto $70 price floor, which was the market stability code, to go into this to accept slight lowering prices to reset baseline. They mentioned in one of their press releases a few months ago about a maximum sustainable capacity, and it's all a bit about almost this detox within the group to kind of get to expose most of the producers which are already producing at maximum capacity or don't have or aren't meeting quotas. So I think Saudi and the UAE realize that they're the only ones really carrying the can here, and that this is a kind of a cleansing for the group. We've mentioned it before about internal compliance and everything else, and I think it's a broader strategy. And I think OPEC Plus will tolerate lower prices up to a point.
Well, OPEC Plus may tolerate, but what about OPEC Plus tolerating all these changes and continuing as a group? Arne, I mean, on that point, the dynamics in the market are changing very quickly. The geopolitics that interferes, the monetary policy, the oil markets are changing. I mean, there's a different way that producers may start to act. I mean, Paul's mentioning that countries like Saudi Arabia, they need to start controlling a bit more of their market share even versus non-OPEC producers. Does that render, groups like OPEC Plus now really just beginning to be very redundant? I mean, it's been almost 10 years now that they formed it and expanded the group, and it's whittling back to, okay, who are the core 8 and who are the core 3 or 4? Do you see a chance that will break in the near future with all these different moving parts?
Coming from a consuming country, you would of course say that hopefully a cartel will eventually break down, and maybe that is actually what we are starting the very small pieces of that. Looking 3, 4, 5 years ahead, there will probably be too much oil in the world relative to demand. Yes, demand will probably continue to grow, but it will be at a slower pace. Electric cars will eventually take over, and so on. And in such
each
a
to
world,
his own, it'll become much more independently sort of managed.
Yeah, but it will be a
policy.
normal commodity like copper or aluminium, and so on will be supply and demand. But it will take a few years. But oil is eventually also moving in that direction. That is my take. But it will take time, and of course, OPEC will fight back, and I think they will fight back eventually. Next year, they will not go through with this 1.65 million barrels production increase. Maybe it is, as I think you, Paul, alluded to, that they are basically trying to form a new baseline and then start from scratch, so to speak. And that would probably be a good idea, because if there's one thing our clients are asking about is they don't really understand what OPEC is doing. They don't understand all these layers of cuts and compensation cuts, and it's all one big mess. So get
Maybe
rid of
it's
all
one
that.
Big PR. It's a PR move, really.
Yeah, but if I was like giving them advice, I'm not. I would say get rid of all that and start from scratch. You need to have a system that the market actually understands. Then you can also have and believes, of course. Then you can also have an impact. It's a bit like central banks. You need to have confidence in what they are doing, and I think they are lacking a bit.
I mean, talking about central banks, do you have confidence that we're going to see more than 1 or 2 rate cuts in the next quarter? I mean, what do you see that going?
Yes, that's I think from the economic point of view, there's probably room for more than 1 and 2. But I still actually see that the inflation is underestimated. It's like a bottle of ketchup. Suddenly it comes out when you squeeze the bottle. We saw that after the pandemic. Remember, people say, "Oh, there's never going to be any inflation. Interest rates will stay at 0 or negative forever." And suddenly 10-year yields were at 5%, and inflation was at 10. And I'm not saying inflation is going back to 10, but there is an inflationary pressure. This is an unprecedented experiment in the world, that you suddenly hike tariffs by, what is it, up to 20%, and at the same time you actually cut the workforce significantly by sending foreigners out of your country. That is an experiment we've never seen before. It might go good, but it also might turn out quite badly. And I'm probably in the camp where I see a risk that the market is underestimating inflation. And it's always where's the market sitting. And at the moment, the market is sitting that things will go smoothly. Inflation will not be a problem. Trump will tackle out.
They made that mistake 2 years ago. We made that mistake after COVID. So here we go again.
Exactly. And the market is also saying if things go badly, Trump will tackle out and remove some of the tariffs. But there's no guarantee of that. So yes, I think there are rate cuts coming because there are room for it. But it may be fewer than a lot of people think.
Okay, Rachel, just back to you as we close. I mean, inflating, maybe there's no choice really, because the US certainly needs to inflate its way out of this huge debt burden, doesn't it? I mean, that is obviously one possible intention behind these rate cuts. Is that the only option it has at this stage, really?
Well, I think it's quite hard to grow out of it. The problem is that I think it's a lot harder even to inflate in this context. And this is all happening at a time where not only is there the pressure on the independence of the central bank, there's this question of how the Trump administration is going to call into question data sources, both of this data, but even the energy data that we sort of, is such an important, case here. So I do think we're relying in the energy markets and more broadly in the macroeconomy on increasing importance of places, whether it's storage and the like, where there's some more transparency questions and the like. And we've seen long-term interest rates move up meaningfully. We'll probably see more of that with the deficit. And that means, I think that says it's not so easy to inflate away. They might be able to bring down the lower end, but the sort of mortgage rates, the sort of investment sort of dynamics Trump is looking for. And that's part and parcel of the shift in the global economy, but also the geostrategic shifts that we were talking about at the start. You no longer have China or the Gulf states buying as many US treasuries as they used to. There's still a desire for dollar-like assets via stablecoins, but this is a shifting environment. It might not happen immediately, but this is not going to be an easy time to deal with the debt burdens, and we see that in the U.S. We see that in France. This is going to be, I think, with us for some time, but to be continued, I'm sure, in the coming months.
A lot of problems in Europe. Obviously, France having a very tumultuous week, obviously politically and because of its economy, really. A lot of instability to come still everywhere. Thank you, Rachel and Paul and Arne, for joining us this morning on Friday, the 12th of September, and wishing everyone a great weekend ahead. All the best.
Thank you so much.
Thanks all.
Have a good day. Thank you. Bye-bye.